It sounds like a great deal. And is it because of kind of where you've positioned the company now that you were actually able to do this?
Absolutely, Ron. We are placing this note and this convertible and being able to do this effectively in the market because we're doing it at a moment of strength.
With a recent financing announcement by Fortuna Silver Mines, the market reacted with quite a sharp downdraft in the stock price. Today, we're joined by Jorge Ganoza. He's the CEO of Fortuna Silver, and we want to clear a few things up. He's going to share with us his insights into why they made the decision to do this financing and what the strategy behind it truly is. Jorge, welcome to Ron's Basement.
Ron, thank you once again for the opportunity to speak to your audience. So
Wow.
to dig into your question, yes, we announced yesterday a placement of a convertible note. So what prompted us to do that? Well, we've been telegraphing the market, and more than telegraphing, communicating directly that one of our capital allocation priorities, a big focus for us is strengthening the balance sheet. But even further, more than strengthening, we believe that a mining company at times like this needs to put together a fortress balance sheet, no? A balance sheet that sets you for the future, allows you to mitigate risks for the business, allows you to capture the opportunities that emerge in the jurisdictions where we operate as well. So what have we done with this? Well, effectively, we have a corporate revolving credit facility for which we pay almost 8% interest, no? And through this convertible, we are going to use the proceeds, the 150 million, to pay down the entirety, no, all of the bank credit facility, and are exchanging almost 8% debt for 3.75% debt. No, so we are improving our cost of capital, and the instrument we are using is a convertible note, which in 5 years could potentially be converted to shares of a company by the holders. Either we pay the principal or the notes are converted, which, it's a flexible facility. It doesn't come with restrictive covenants. People need to understand, your audience needs to understand that, a corporate facility like the one we had in place was quite restrictive in the covenants, no? It really limits the company on, for example, return to shareholders, limits our liquidity at times of, issues. I'll give you an example. Last year, when our shares were trading at $2.70, we have a share buyback program in place, and we were very keen to participate in the market and buy back our stock, which is a smart way to return to shareholders. And we could not do it because the covenants of the facility restricted us from doing that. Right?
Yeah.
So it was very painful for us to see the share price at $2.70 and not being able to do a repurchase of shares by the company. But those are the type of missed opportunities that we had due to the restrictive covenants in the facility. With this new convertible note, we're not only lowering the coupon, the interest rate on the money, but also getting rid of all of these restrictive covenants that the banks put in place, right?
Okay. So I think it's important for our viewer, and I'll reiterate it and repeat it. Essentially, and you correct me if I'm wrong, Jorge, you are replacing kind of high interest rate debt with a lot of restrictions attached to it. You're replacing that with lower interest rate debt, almost half interest rate, 50% saving. and it will allow you much more flexibility. Are you able to do this now? Because I mean, when I look back at the performance of Fortuna financially, operationally, over the last 9 months, 12 months, things have been going very well for the company, generating huge cash flow. There's a lot, you paid off over $120 million in debt over the last 9 months, I think it is. Has that given you this the platform from which now you were able to, I mean, to me, this sounds like a great deal, right? I'm an accountant. I believe in, limiting expenses. I think that's kind of common sense for everybody, but it sounds like a great deal. And is it because of kind of where you've positioned the company now that you were actually able to do this?
Absolutely, Ron. We are placing this note and this convertible and being able to do this effectively in the market because we're doing it at a moment of strength, right? Not at a moment of weakness, right? Now, for note, we went to the market to raise $150 million in debt through the convertible, and we got $500 million of interest for the notes. So it was in the debt market, if you will, it was a big success. Grossly oversubscribed.
Yeah.
We got really good terms, the lower cost of capital. And again, we're doing this at a moment of strength. Let me help you put a scenario in front of you so your audience perhaps can understand better. Yes, we're generating very healthy cash flows, and we've been paying every quarter about $40 million on debt. We're not a highly debt leveraged company anymore. Our debt is 0.4 times EBITDA. Typical covenants allow you to go as high as 3 times debt to EBITDA. We're at 0.4. So, we're a company that generates almost $1 billion in revenue this year, and we are, doing a debt restructuring for $150 million, and the shares in the market sold off as if a tailings facility had failed. The type of market reaction was yesterday as if there was a fatal flaw in the business, a catastrophic event at one of our mines. That was the type of market reaction, because a company that generates $1 billion in sales is changing 8% debt for 3.75% debt.
Yeah.
No,
yeah.
That's that. Now, let me paint a scenario. Currently, 35% of our NAV is assigned to the Séguéla mine. And I think that mine will increase in its participation in our NAV over the coming 12, 24 months because we're doing really good at that mine. We're finding more ore, the plant is processing more. So the net asset value contribution of that mine to the net asset value of the entire business, I think we'll get probably closer to 40 or even 45%. Now, what happens if we have a climatic event, flooding? What happens if we have a geopolitical event, a coup d'etat in Côte d'Ivoire? What happens if we have a technical operational failure, let's say, or ball mill or SAG mill that crushes the rock, has a technical failure and is out of line for a month, 2 months? What happens? What happens first is that our cash flows will be impacted. Second, the shares will come down, will drop. And third, our balance sheet will be impaired because the restrictive covenants of the facility that we've been working with will not allow us to tap into the credit line.
Right.
Will restrict us. No? Those are, so, what I want to say to you here is that when things are good, everything is rosy. But we as management need to place ourselves in every scenario. and a scenario where the Séguéla mine has an issue to contest with, that will impact our cash flows, it will impact the share value of the company, and will impact our credit facility. So we will be in a very difficult spot to contest with the challenge that we would be facing. And again, it could be a climatic event, a geopolitical event, a technical failure, and those are scenarios we face ourselves. So what we're doing right now is removing this restrictive, covenant-heavy credit facility that is expensive, almost 8%, and renewing it for one that has almost an interest rate of 3.75, almost a half of that, of what we're paying right now, and has no restrictions. We're not restricted to use the cash at hand.
Right.
So we're managing risk for your business.
Yeah.
Right?
Protecting the capital of the company, protecting the capital of the shareholders as well.
And using the balance sheet, shielding the balance sheet, so in case there is any such events, we can operate and deal with the issue. Right? That's why it's important. Mining is a capital-intensive business. It's a complex business. As I just described, we're exposed to all sorts of risks.
Right.
Operational, climatic, geopolitical, social.
Mm-hmm.
And
weather,
right? Having a strong balance sheet is key. And we are coming out of a capital-intensive phase. And what we're doing is consistent with what we've been telling the market. We want to put in place a fortress balance sheet that will shield their business in case anything happens, and also a balance sheet that will allow us to capture opportunities as they emerge.
Yeah. Right. Yeah, no, that's I've been investing in mining companies for long enough to realize that all types of different things can happen. And while we don't want to think about the worst case scenarios unfolding, right, from time to time, they do. And you want to have a company that's not so leveraged or is not in a position where they can't adjust to weather any of the myriad of issues that could come up. But like you said, also it also positions you to capture other opportunities as they come along as well.
Yeah. Again, a real example of what we've been dealing with. Last year, the shares were at $2.70. We had a share buyback program in place under which we could execute, and we couldn't because of the lawsuits we had in Mexico, that, by the way, never stopped the mine for a day. The Mexican operation never lost one day of operations because of all of that nonsense and the issues we dealt with the Mexican Environmental Authority. We have never lost one day of operations. But only the fact that we had a lawsuit that we had to contest with precluded us from doing a share buyback and return to our shareholders at a moment where it was strategic to do it with the shares at $2.70. So, that's just an example of an event that we have to contest with recently, right?
Yeah. And I want to point out as well, you've been building this company over almost 20 years now, and you brought up the example of Mexico. For our viewers who aren't aware, but there were some permitting, I don't want to say issues, but just permitting challenges over maybe it was 2 years ago, where Jorge and I both got more gray hair during the period because there were very just unbelievable issues that were brought up but you managed the company through that. And like you said, you never never shut down the mine for one day. But what I want to point out to the viewers during that period, because I own the stock now and I owned it then, there were times when I think the market overreacted and the stock dropped significantly, right? But based on your experience and your leadership and management abilities and your team as well, were able to manage through that and manage that process. The other thing I want to bring up regarding what I would call market misinterpretations, which I really feel like happened yesterday. The market misinterpreted what I think was a great thing, a great move by Fortuna, was when you made the decision to acquire Roxgold almost 3 years ago, and which turned out to be a fantastic decision for the company. But I distinctly remember that when the announcement was made, the market didn't quite understand it all, and there was a big drawdown in the stock price, right? And now, 3 years later, we look back, and that's, I think, unanimously, everyone agrees, was a great decision on your part and the leadership at Fortuna.
Thank you for that comment, because, again, it was June, July 20. No, the announcement was in April of 2021.
Mm-hmm.
And the stock of the Roxgold acquisition, and the stock dropped as if, again, we had a catastrophic failure. Well,
right.
we are used to taking the long-term decisions, so we knew to get out of the hole and get our stock price up again, we just needed to, put our hard hats on and get to work at that mine and do the integration and get to work. And there were some legitimate concerns at the time regarding our ability to integrate a West African business, our ability to build the Séguéla mine, and all of those things. Well, we, over the last 3 years, that's exactly what we did. We did it on time, on budget, with success. And now people say, "Oh yes, that was a great move." I laugh, like you say. Inside of me, I laugh, because a lot of those same people were tremendously critical, and now they say it was a good decision. And yesterday, with something that makes the world of sense strategically, we have a Fortuna that's financially, we achieved our objective of putting together a balance sheet. We have, by the end of the year, we'll have about $380 million of available liquidity to the company, without many restrictions that give us freedom to manage the complexities of the business and capture the opportunities that will emerge in the jurisdictions where we operate. And yesterday, the stock of the company, unfortunately, dropped 14% at the end of the day. It was down as much as almost 20%. And it rebounded, it closed it down close to 13, 14%, but traded as if there was a catastrophic event, as I am saying. No, as you look at the share performance, you say these guys had a tailings failure, a mine collapsed, the pit wall collapsed, something like that. Again, I think there was some technical selling driven by the hedge funds. There was momentum selling. There was emotional selling. And then some guys who just don't know what they're doing, and they just sell for selling. But there was a bit of everything yesterday. But today the stock is rebounding, and I have no doubt that, Fortuna is better and stronger after this, and the stock will come back strongly. I don't have a doubt.
Yeah. Well, I think you mentioned something earlier that I thought was really interesting. Number one, the interest rate on these convertible notes is really low, 3.75%. But what you said was that there was almost a $500 million, $500 million in interest in these notes. Oversubscribed. I'm not an expert in debt issuance or anything like that, but I would think that are we correct in kind of connecting the dots and reading between the lines that your ability to secure such a low rate on the debt, coupled with that $500 million in interest of people that wanted to buy, that indicates that the market perceives Fortuna also as being strong. Does that make it? Wasn't like it was undersubscribed, it was vastly oversubscribed, and you were granted a what I think is a low competitive rate.
we were granted a very competitive rate, and the oversubscription, I spent with our CFO 3 days of back-to-back meetings with investors interested in purchasing the notes. And, after that, the outcome was that we were, tremendously oversubscribed. We went to raise and of course the bankers were saying, why don't we upsize that and take more money? And we were saying, no, what we need is $150 million. And
Right.
that is what we believe is right for us, because we could have taken 200, 300, we could have upsized it as much as we wanted. There was $500 million worth of interest.
Yeah.
And I think that's a big vote of confidence on the fundamental strength of the company.
Yeah.
At the same time, as I say, the market was selling off as if there was a catastrophic failure.
Right. And there, I know there are, and it's not an area that I honestly completely understand, but I know that when these financings go through and they're convertible to shares at some point, potentially in the future, sometimes there's interest in certain entities shorting the stock. And I know there was huge volume yesterday. So,
yes, there was, yes. When you place instruments like this, it is not uncommon to see, particularly hedge funds that take place in the placement, shorting the stock to lock their pricing. But there was certainly, we placed what, $20 million worth of notes, no?
Yeah.
We traded $100 million yesterday. So there was certainly, the hedge funds can hedge, but not $100 million. They'll hedge, I don't know, 20, 30.
Right.
So there was certainly, I think momentum traders, when they see momentum, they just come. Emotional trading, guys looking at the stock coming down and they're just getting out, and
Right.
things like that. But you know what? It would be ill-advised to run a mining company or any company to that end, looking at the share price on a day.
Yeah.
No, I again, or what we think, Ron, is what are the risks of the business? How do we mitigate the risks for the business? How risk averse are we for some of the risks? How much risk appetite we have for some things, and the opportunities out there for us to create more value, fundamental value, and then strategically act upon them. And as I said, putting together a fortress balance sheet is important for a company like us, who operates in 5, 6 distinct jurisdictions with their own sets of challenges. Yeah. Right?
Yeah.
From geopolitical to operational to climatic, all sorts of risks, right?
Yeah.
So that's, if the share drops on a day, and sometimes we have to do a better job communicating, and that's a criticism that I can take. But I think we've been saying very clearly we're looking to strengthen our balance sheet, and this is a move in that direction.
Well, and right now, today, you're communicating. I know you talked with Chris Marcus and Dave Kranzler earlier. I think it's great that you are willing to get out there and communicate with the market as to what the strategy behind this move is and why it makes sense. Because, if we want to talk about something that I think will make us both smile right now, is, the precious metals prices are way up, and I would imagine that's benefiting the company as well.
We were selling gold at the end of last year. Our average price for that last quarter of the year was $1,990. In the first quarter of 2024, we realized $2,084, $87. Today, gold is trading strongly about $2,300, no? 23, 24.
Yep.
So yes, we are in a great position to benefit from the rise in metal prices. Our business is doing well. Mines are performing along in line with our expectations. So our three capital allocation priorities is balance sheet. We have just, I believe, achieved putting together that fortress balance sheet. Harvesting the portfolio or organic growth opportunities. We have this year our largest exploration budget on record, $42 million. I just spent almost 15 days in Africa visiting our mines, our exploration projects, and we're coming out of that and looking to expand our exploration budget by another $5-6 million. We have a very exciting discovery at the Séguéla mine. It's named Kingfisher. We already had an announcement on that. It's a public announcement in a news release. But I believe Kingfisher has the potential to be a very significant resource and eventually reserve. We're going to continue drilling. We're extending our budget, expanding our budget so we can continue drilling Kingfisher with 2 rigs all the way until year end, with the aim of producing the first resource estimate at this one deposit. So it's a new blind discovery. We're very excited about it, and I believe it can potentially have a meaningful contribution to production, eventually successful with exploration. But it's looking very good.
Yeah.
And just lots of opportunities there. And that's the capital that supports all of that. It's a priority.
Mm-hmm.
Last, opportunistic M&A, opportunistic participation in the market on share buybacks. That's the instrument we have today at hand to return to our shareholders. But again, you know, I don't follow, you know, Twitter. I have a Twitter account, by the way, but I don't, but, you know, I'm not very active there. But it's funny to see with the drop in the share price, there were some people saying, you know, that we were buying shares and now we're selling shares. And I'm like, you know, some guys just don't get it, right?
Right.
We were buying shares when the share price was at $3. Yes.
Yeah.
That's
right.
what you should do.
Right.
No?
Yeah. Good move.
Clearly, we were buying our stock back at $3. $3 from $3 to $3.40. We were very active in the market. We bought 1 million shares. I would have liked to buy more, as I said, when the stock was at 270, but nevertheless. And then we are issuing this note with a strike price or conversion price of $6.60.
Mm-hmm.
And, you know, in 5 years.
Yeah.
And we have the option to pay it down, you know. So, you know, and some guys also saying that there is management doing an equity placement or raising money to pay salaries, to pay their salaries. I mean, they humor me.
Yeah.
With those things. Fortuna is a company that generates revenues of about $1 billion a year. We operate with a EBITDA margin of 42% today. We certainly do not need a $150 million debt placement to fund the salaries of management by any means.
Right. No,
but yeah.
And I think you brought up a great point, because I'd been several people reached out to me as well, like, well, why were they buying back stock and now they're issuing stock? And correct me if I'm wrong on this, but the new stock won't be issued unless it's converted, and that would be at some point in the future. And like you said, Fortuna was buying back stock at $3 per share. And the potential, if this stock even does get issued, it would be at more than twice that level. So I think that's a pretty good
very simple
shepherding of shareholder capital, right?
very, very simple. You just explained it better than I. No, we were buying stock at $3 and canceling the stock. No,
yeah.
creating value for shareholders through that instrument. And then under the current note, in 5 years, in 2029, those notes could be converted, to shares, or depending on scenarios, we can pay the principal and cancel them,
And cancel
right,
it.
without the conversion. So yeah, but you buy shares when you believe you are undervalued from the perspective of NAV, no? Because we don't trade. I look at NAV, I do a NAV assessment and net asset value assessment when I decide to do these things. And we as a company decide to do these things. And at $3, we saw a lot of value. And at $6.60, I believe we should be comfortable with taking the risk that 5 years from now, perhaps we can convert or pay it down, depending on the scenarios.
Yeah, yeah. And in the interim, I'll repeat one more time, reducing your interest rate that you're paying on debt by a little, almost 50%, or maybe even a little more than 50%. I followed the company for years and years. I always believe that you have the courage, and the rest of the management team as well, to make good strategic long-term decisions. I think oftentimes in a world in which we live, where everything is managed week by week or quarter by quarter, that can sometimes not be appreciated by the market. But I believe that in the long run, that's what wins the race, and you've proven that over and over.
You touch a very important subject. I find one of the most difficult aspects of my job as a CEO, chief executive officer of a company, and is balancing the long-term decisions that you need to make with the short-term pressures of the market. And I respect our shareholders, I respect our investors, and I do know that they are very sensible to quarterly performance, quarterly share performance. There are fund managers that are measured quarter by quarter, but we are in the middle, having to make those long-term decisions, and sometimes balancing those short-term market pressures. And that's a very difficult thing to do, and sometimes you cannot please everybody all the time. But sometimes we have to make the strategic long-term decisions and be willing to take some short-term pain. You just described the Rocks Gold acquisition. I think that has set up the company for the future. Today, half of our production comes from Africa, but more like 70% of our cash flows come from Africa.
Yeah, yeah. And let me interject. We are now 2/3 of the way through the second quarter here of 2024. Hypothetically, when you report your second quarter results, we'll be seeing the benefits of what at the time was a difficult long-term decision 3 years ago, when you decided, that over time, if all those decisions, solid long-term strategic decisions, while you are balancing the short-term with the long-term, but over time they accrue and add up and result in a company that can be successful for 20 years, almost 20 years as you have now, but continue to be successful for another 20 years as well.
We're trying to build a business sustainable over time.
Yeah.
And good assets, good people, solid balance sheet, optionality in the business, a business that can perform throughout the precious metals price cycle, in higher price environment, reap the benefits, in a lower price environment, still be a viable, attractive business. So, that's what we're trying to do for our shareholders. I am very important part of my net worth is in Fortuna. I am a long-term shareholder.
Yep.
You know, I think long term, is it painful for me to see the shares drop 14% in a day after, you know, something that we believe is good? Yes, it is. But you know what? I'm willing to look beyond because I know fundamentally the business is stronger, and it's a sound decision. So as an investor, I am perfectly fine with it. No, now if you like to trade a stock or you bought the shares on Monday, well, you know, you have to take some pain there.
Right.
Yeah.
That's right. Jorge, it's been great talking to you. I really appreciate you taking the time to communicate with me, with my audience. A lot of my followers are keenly interested in Fortuna as well. I think you provided us with a clear vision as to the strategy behind this decision. And it really is exciting to think about the company, where you've positioned it now, and what we can look forward to in the coming quarters, years, you know, and decades as well. Is there anything I forgot to ask you? Any parting words before we say goodbye?
Just a note, an observation, because yesterday we traded over $100 million worth of stock,
Mm-hmm.
and today market is not closed, but we are already we have traded more than $100 million again worth of stock going up.
Yeah.
No, we are up almost 4 or 5 percent.
Mm-hmm.
No, 4% with over $100 million worth of stock trading. So, you know, there is been significant buying, pushing the stock up again. I think longer term, I'm very comfortable that medium term, short term, more comfortable that we'll be in a good spot again.
Yeah. I think when there's kind of dramatic reactions like yesterday, it was probably a combination of some shorting combined with people who were, I don't want to say weak holders, but not necessarily convicted to the long term. And now when people come back in, I mean, in some ways it's actually good because it washes out the weak holders of the stock and provides a strong platform from which potentially things can continue to grow from here. And as the company continues to grow and perform, you know, we'll be optimistic that that will be the case.
Thank you for the opportunity to speak to your audience, Ron.
Well, Jorge, it's always a pleasure. And again, on behalf of myself and our viewer who joined us today, you know, as the CEO of a over $1 billion market cap company, you know, it's a big honor to get to hear directly from you. And we'll keep supporting Fortuna and look forward to talking to you next time.
Thank you. All the best.